So with all the anxieties we have out there, flying, congestion pricing, let's talk about investing, yes?
Oh, that's fun.
Yeah. Are you all in, or does the idea of investing make you anxious?
Makes me anxious.
It makes you anxious, and you're not, you're like a lot of people out there. So a lot of people say to themselves, where do we even begin? There's a new survey from Bankrate that reveals Americans' top choice for long-term investing is the stock market, but it also shows that 21%, look at that number, say they prefer not to invest in stocks because it is intimidating. But it does not have to be, because we've got CBS News business analyst Jill Schlesinger here with a little investing 101, as Nate calls you, Dollar Dollar Jill.
Yes.
Good morning.
Good morning. I'm excited about this.
Help people who are worried about their Benjamins and where their Benjamins are going to go. Why is investing so important? Why should people be in it?
The whole point of investing is to grow your money faster than the inflation rate, right? You want your money to work hard for you. And what we know is if we look back in time, we know that stocks over the long term do tend to go up. So like the last 10 years, which, was pretty bumpy along the way with COVID and the stock market plummeted. If you put $100 into the stock market 10 years ago, it grew to $295. That's an 11.4% annualized return. So I want you to compare 11.4% a year versus over that same time, if you put your money in the bank, maybe you got a good rate in the last couple of years, but prior to that, it was basically 0.5%. So you've got to have a long enough time horizon to weather those storms. And I want to be clear, no matter what, the moment you begin investing, there will be a storm and it's going to test you. So we always want to really underscore, don't invest unless you have at least 5, 10, 15 years. That way, those downward movements won't freak you out as much.
What about this idea of diversifying investments, and how should people go about it? Should they go to a person? Should they use an app?
So I want to go back one step. And when we talk about diversification, we're talking about asset classes, like different categories of investments, right? So stocks, which is basically the ownership in a company, that's one asset class. Bonds, or fixed income, that's where you lend an organization money, they pay you back interest. Could be the government, can be a municipality, could be a company. There are commodities, like you could say, oh, I want to buy gold. There's real estate, or you can have cash. So what diversification basically is betting on is that these assets move differently over time. So when one is zigging, the other one may be zagging. So when the stock market is plummeting, you might say, hey, my bonds are doing okay. There are weird instances where everything goes down at once. That was 2022. That does not happen very often. Again, over the long term, based on your risk your risk tolerance, like how much you can stand, how much time you have before you need the money, that will determine how much you want in the risky stuff like stocks and how much you want to keep in the cash stuff or the bonds.
One of the things that was fascinating to me when I worked in finance was seeing how investors reacted when they saw those ups and downs in the market. When the market was coming down, actually people took their money out of the market, and when it was going up, that's when they started to put money in the market, which is the opposite of what you should do. So mutual funds are an attractive vehicle for people who don't really know what they're doing and are led by their emotions.
Right. So mutual funds is a pooled investment, meaning that we all put our money in, then the manager will go out and pick the stocks or the bonds or the real estate investments. Now, one type of mutual fund that's really great is called an index fund. An index fund will track a specific index. You've probably heard of the S&P 500, but there are bond indexes. What you really want to do is concentrate on index funds, especially to start, because they are the cheapest. And I love cheap. When you save money on expenses, it flows to your bottom line.
Meaning cheap, that you are not paying heavy expenses in the mutual fund.
In the mutual fund, and you're not paying a manager to pick those different companies or those different holdings. Just remember, if you're starting out and you're looking at a retirement plan, sometimes there's something called a target date fund. It has a date at the end. That's not going to erase your risk. It's just an easy way to start investing. So it's targeting a date when you'll begin your retirement, and the manager will shift between stocks and bonds and cash as that date approaches. A very easy way to start. Jerika, how do you feel right now?
I feel great.
Feel
I
less
have to say,
anxious?
I mean, it's...
She paused.
That's not my forte, so I let a financial advisor handle that. But I have to say, some of the best advice you gave me 11 years ago was to start a college fund for my daughter.
There you go.
So I can't believe it's been 11 years.
Amazing.
Here we are.
Listen
Yay,
to
let's
Jill,
go.
America.
Yes,
listen
I do
to Jill.
listen to Jill. Thank you.
Thank you, Jill, very
Great
much.
advice.
If you have a money-related question, just like Jerika did 11 years ago, you can send an email
Still got 'em.
to askjill@cbs.com, and she might answer it in an upcoming segment.